Using order blocks in your Forex trading is arguably a very great solution to better understand where you could enter a position and increase the probability of your trade success by reducing the chances of falling into liquidity hunts. What is an order block in Forex and why bother with it? Understandably, these questions would be in your mind, and they are both good questions. An order block is a technical analysis technique that tracks the accumulation of orders when bullish and distribution of orders when bearish of banks and institutional traders. In other words, it is an area or an indication of where big institutions would pile up their orders to enter the market, their order blocks. Although Forex is a decentralized market, it is strongly influenced by central banks' decisions and interest rates and other big institutions' positions. And if you know these whales can influence the market, it makes sense to factor their activity in your Forex trading. To explain what is happening behind the scenes when the market starts to range and the price is consolidating. This is important because the central bank is allowing the price to consolidate and allow hedge funds to place their orders in the market, while commercial big institutions are providing the counterparty liquidity. However, on an intraday basis, we don't look much at the interest rates, but more on what pool of liquidity the central bank is going to target next. In very simplistic terms, this means explaining what liquidity means and why there are times when the market is liquid while other times it isn't. However, one way of anticipating and timing entry is by trading the order block. Given we have the right direction in mind or the right market bias, the price makes sharp moves towards liquidity areas once the price hits the order block level, because big institutions are also placing their orders within the same levels. Why order blocks form? To understand order blocks and why they form, it is important to understand why they form and the narrative behind their formation. This is because not every order block is high probability. There are certain characteristics that you need to look for in an order block to characterize as a high probability. Also, you need to understand why a specific consolidation or area would be considered an order block by understanding why the price is retracing to a specific consolidation and where the price will be reaching next. In a bullish market, bullish order blocks are represented by a down close bearish candle on a given time frame before a strong bullish move. When going down to lower time frames, this same bullish order block, one down close candle, will show as a consolidation that is called accumulation. So, considering order blocks are regularly traded by big financial institutions, it is logical they should be accounted for when a retail trader places trades. How to identify an order block in Forex trading. The good news is you are now aware of the benefits of knowing about Forex order blocks and why they form. However, for people new to Forex order blocks, finding the high probability order block can be a little challenging until you improve your skill with practice. Order blocks appear in trending and ranging markets, but how to use them is a little bit different in each market. Also, note that ranging or trending market is always relevant to the time frame the order block is found. But as a general rule of thumb number 1, the higher time frame always has the most influence on which order block to choose. But generally, order block Forex usually form after a strong impulse leg up and down. However, as a general rule of thumb number 2, if there are orders, you should see price moving away from the order block quite fast or in a short period of time, relevant to the order block time frame. If you don't see any reaction in price, then it's most likely that this order block Forex is not high probability, and it would be better to look for re-evaluating your analysis. When to look for bullish order blocks and when to look for bearish order blocks. This has been one of the main reasons why, despite the popularity of the order block in recent years, there are still many who fail to identify high probability order blocks and fail to know when to look for bullish or bearish order blocks. There are many sources saying what is a bearish of bullish order blocks, but they fail to address the question of when to look for each. Rule of thumb number 3: when the trend turns bearish, you should only look for bearish order blocks. The trend turns bearish only when there is a break and shift in market structure. After the shift in market structure from bullish to bearish, you don't look anymore to bullish order blocks as a place to enter your next trade. Instead, you must look at new bearish order blocks to enter your shorts and aim for the price target of the liquidity pools below those old bullish order blocks, and vice versa. When market structure shifts from bearish to bullish, the trend becomes bullish, and you start looking for pullbacks to new bullish order blocks and target liquidity pools above previous old bearish order blocks. The more you practice, the better you will get. But keep the following facts in mind. Don't forget to always have these in the context and in line with higher timeframes, daily and 4-hour.